Hey, gang. In this one, we're going to talk a little bit about subsequent events. This is stuff that happens after the financial statement year end, let's assume December 31st. And does that information, whether it's in January or February, before we release the financial statements, does it give clarity to something that was actually in effect at December 31st? Then you record it. Or does it just have significance, but no relevance to December 31st, but readers would want to know about it? A la an earthquake, a job strike, issuing of a new bond, acquiring a new company, etc. So we're going to look at all of those issues during this segment. What we want to do is we actually have a nice little flow chart for you to look at. And let's make an assumption that this year was January through December of year X6. And ultimately during X7, January and early February, we were doing an evaluation. That's the subsequent events period. We're asking ourselves, did a condition exist at the balance sheet date that needs us to post it? If the answer is yes, recognize it. A settlement of litigation where you're going to ultimately report the precise amount that you lost, or a loss on an uncollectible receivable. The classic example, one of your customers declares bankruptcy. Those would be great ones. Now remember, if it was a gain, you wait until it actually happened. You don't anticipate it in advance. On the other hand, if that condition didn't exist at the balance sheet date, but it's something that's happened during that interim evaluation period, and it's important, like the sale of stock, a natural disaster like a flood or an earthquake, or the settlement of litigation ongoing after the balance sheet date, then ultimately you're going to consider it as a non-recognizable. So if something happened afterwards and ultimately got resolved afterwards, before the ultimate release, you'd want to consider it. But even after that, would not disclosing the event make the financials misleading? Well, then you have to disclose it as well. And if one, it's not related back to last year, and number two, it would not make the statements misleading, you can ignore it. So in each and every one of those items, that's probably the best thing to look at. So if financials, by the way, are restated or revised, the evaluation period does not extend to the restatement or revision, but to the original, quote, issue date if the entity is an SEC filer.